What's happening right now is it seems like the government spending is so high, you would think that things are worse than we're led to believe because of all this government spending. And again, how are we going to get out of a recession? It's probably lowering rates. It's really the only way to do it.
Welcome to The Flow, Real Estate and Money Show, a show focused on helping Canadians understand the different elements of real estate, mortgage, and finance. The goal of our show is to provide Canadians with the tools, information, and knowledge to have more success when it comes to their investing and real estate related decisions going forward. My name is Alex McFadyen, and I'm your host. I can't wait to get you into the flow.
All right. So we were just finishing a conversation. You were telling me about market share in Canada. And you sent me this graph, and it was absolutely very interesting to look at. But we're going to keep our listeners hanging for a quick second here. But I want them to hang tight for a second here, because they're going to be very interested in what you have to say here, Mr. Bruno. Bruno Valko joining us all the way from just outside of Toronto, right?
Kitchener, Ontario, yes.
Kitchener, Ontario. There you are. Typical West Coaster. I don't know the difference between the different cities, but thanks for clarifying, Bruno. So Bruno comes to us all the way from Kitchener, Ontario, and he is the VP of Sales of RMG Mortgages, which is a part of MCAP Mortgage Corporation, one of the largest non-bank. In fact, if I know correctly, I think they're the largest non-bank lender in the country. Is that right?
Yes, they are the largest mortgage finance company. So, and it's a multi-brand approach. RMG is one of the brands, and there's multiple brands that participate in the overall MCAP group of companies.
Awesome. Love to hear it. So, Bruno, I think I'm just excited to have you come on and have this conversation today, because you're a self-proclaimed data nerd, which is always fun. And for listeners, I think that what that says to me is that you're someone who actually goes deep on the information. You're not necessarily just surface level. And just in our conversations, I've already learned that you do a really good job of articulating not necessarily just what's happening, but how things occur from a perspective of, or just in the way that things impact, I should say, the average consumer, the average mortgage holder, and so forth. In fact, you send out these weekly or biweekly emails giving us a great rundown of what's happening economically speaking, and you make guys like me look like geniuses when in fact we're just leaning on smarter guys like you. So thank you again, Bruno, for joining.
Oh, thank you. I appreciate it. The emails are meant to educate mortgage brokers. And when you deal with mortgage brokers, obviously you deal with a wide variety of brokers with different knowledge bases and so on. And yes, I do like to send out those emails. It all depends when they come out. Today we had an inflation announcement from Canada, so I felt it was a good opportunity to let everyone know what the inflation looks like and what is impacting inflation the most, which is basically mortgage interest costs. So I thought brokers would be interested to know that the inflation on mortgage interest is 30%.
And it is really key to know this type of information. A question for you, Bruno, is have you always had this interest in this type of data and information? Like, have you always gone this deep in regards to understanding the economics, quote unquote, that used to be behind the scenes, but now seems to be front and center?
I did go to York University. I got an economics degree. So economics is definitely something I'm interested in. It's a BA in economics. As the VP of sales, I've been a VP of sales at different companies. Back in the day of First Line Mortgages, I was a VP there, and that's where I began sending out these economic updates. First Line was a division of CIBC. Ben Tal, of course, is the economist there. A lot of people on your call and you would probably know Ben. So Ben would do presentations, he would prepare reports, and then what I would do is I would take those reports and I would summarize them for our mortgage broker to be able to understand them and then to deliver them to their clients so that they know what to understand in terms of what is going on. Now, that was actually at a good time too, because that was in the early 2000s. And if you recall, that's when we had the dot-com bubble in 2001 and interest rates began to plummet. So it was a good time to let brokers know what was going on back in those days. And that's where I kind of got that, and that's why I'm doing this right now.
And that's become obviously pretty useful and pretty helpful here in regards to being able to break down and explain information. I was having a conversation with someone the other day in the industry, and I said, and I haven't been in the industry quite as long as you have, but having over 10 years in the industry gives you a little bit of a bite size to understand how people consume information and what's changed. And I said, the biggest thing that I noticed in regards to how people digest information now in regards to the lending space is like all of the economic data is out and in the public virtually immediately as soon as it's published. And there are now plenty of people out there who not only provide opinions but break this down and clarify information. But the biggest problem that I see in that is that there's a lot of instant reaction without analysis and a lot of data that's thrown around and warped and changed. And so I always tell people to ask good questions about why is the data doing this versus just looking at it and making a quick assumption. And again, kind of coming back to your point, I guess just as someone who's been reading and reviewing this data for so long, have you noticed that to be the case? And have you noticed that this data has impacted how consumers react, respond in the last number of years?
I mean, you're correct in terms of data availability and coming from various different sources and various different directions. From my perspective, and this is just me personally, I like to motivational speakers and I like reading some of motivational speakers. But what I did is I kind of latched on to a guy by the name of Brian Tracy, who's actually from Vancouver. And I said to myself, why am I reading all these different motivational speakers? Why don't I just read Brian Tracy? I like what he has to say. I'm motivated by his books. I like his goal setting. I like all the things he talks about. I went to see him live a couple of times, once in Dallas and one time in Toronto. And I kind of felt if I focus in on one that I like because of maybe how he delivers the message, how it's practical, how you can put it to use. So that's kind of what I do when I send out these updates. I kind of try to make them practical and I try to say, hey, here's the inflation number. Here's what's impacting inflation the most. I try to keep it a very quick read. I find that if you don't want to put out something that's pages long because you lose people's attention. So it's a quick read, summarizes it. I put some graphs in there, put the data. I'm a data kind of guy, and then I send it out. And yes, people can get that information from different sources, but a lot of people really like my emails, and I get a lot of good feedback that really, wow, I love it. Keep sending these. It's an easy read. It's a quick read. It educates me in terms of what's going on because mortgage brokers are busy, obviously, with clients, getting deals done. As rates are starting to come down, the volumes are getting better. I think, going into next year from what we see, we should have a good 2024. So I like to do that for them. Say, hey, listen, if you're following these different economic updates, you know what? If I can just summarize it and send things out weekly or bi-weekly, you can share that with your referral sources, your realtors, your clients, and so on. So that's kind of the perspective that I take with these communications.
Yeah, and a great perspective because the information, the data is fantastic. With that being said, I mean, I guess my initial question I want to circle back on, Bruno, is given the fact that this information again is published so frequently and so quickly out to the consumers, I think consumers are smarter and more educated, as I mentioned, ever. Would you suggest that the market itself reacts quicker than ever before to these announcements? And if so, do you think that it happens based on what you'd expect to happen, or has there been anything that you wouldn't have expected based on how quickly this information gets out there?
Consumers are definitely being educated a lot quicker. They know what's going on. They get the updates. I would say that the answer is yes. I mean, again, being a data type person, I'll look at, okay, what percentage of our business has been variable over the last year or so? And the percentage of variable, let's say after the last 12 months, previous to the last couple months, would have been like 95, 98%. Right now, we're seeing about 25% going into the variable adjustable rate type mortgages because the consumers are more educated. They're hearing that potentially rates are coming down, so they take the convertibility option of a variable mortgage more so now than they would have, say, 6 months ago or 1 year ago. So definitely we're seeing quick changes in appetite for mortgages and the types of mortgages people are now looking at based on the information that they're getting and the knowledge that they have in terms of what interest rates are going to do. and some forecasting. I mean, again, I don't like to make forecasts. I like to send out emails educating brokers in terms of others, like, hey, what's the Fed saying in the US? What is the Bank of Canada saying? And then maybe some, financial institutions, what are their predictions and what are they basing it on? Many are looking at the amount of mortgages that people have coming up for renewal in the next 3 years. We have $900 billion more than that coming due in the next 3 years. So what's the impact there in terms of what the Bank of Canada needs to look at when they look at interest rates, and what sort of renewal rates are these people going to get? Because we know the mortgage is probably most of the time your largest debt, your largest payment. And if that payment goes up 30%, we know that that's what we heard today, is inflation on mortgage interest costs is 30%. That's a lot of money coming out of the economy. So if your mortgage payment is $2,000 and now it's $2,600, and you're talking $900 billion of these mortgages coming due, I think it's $128 billion coming due in 2024. They got to look at that and say, hey, can we have that much money coming out of an economy that arguably today is in recession? I mean, a lot of economists will say that we are already in a recession based on what we're seeing, based on the numbers. The economy isn't overly healthy right now. So how much can we afford to lose more money because people have mortgage renewals at much higher interest rates and much higher payments? So many are looking at that as a potential cooling factor in terms of interest rates, and saying that rates will likely have to come down to compensate for all these mortgage renewals coming due.
Well, you just said to me that you don't like to make a lot of predictions on this, but perhaps what I'll do, instead of asking you to make a prediction, is I'll ask you to give me your insights based on what you've seen out there. So we just talked about the billions of mortgages coming up for renewal, and there's a lot of people out there giving their feedback and suggestions on what these mortgage renewals will mean for the marketplace, but what more or less what they will mean for real estate. Now, if I'm reading between the lines, what I'm hearing from you is that, notwithstanding, what's going to happen to consumers, but the fact that we're heading to some form of what likely could be a recession, or maybe we're already in a recession, according to some people, that this will but it will have a definitive effect on interest rates. Did I hear that correctly, Bruno?
That's what a lot of economists are saying, and it makes sense. So again, does that make sense? Does it make sense that mortgage interest costs are 30% inflationary because the Bank of Canada has increased rates? So the Bank of Canada is responsible for higher mortgage interest costs just by setting the Bank of Canada rate. If that Bank of Canada rate were to come down, then obviously mortgage interest costs would come down from 30% to whatever they decrease that interest rate by. Now, are they going to go back to where they were? A lot of economists would say that's not going to happen, but certainly there is a lot of predictions for 2024 for interest rates to come down. And all these mortgage renewals are part of the reason why. Because if we're already in a slow economy, how much money can be siphoned out of the economy because people's mortgage payments are going up 30%? I mean, that's a huge implication on the economy and spending, retail spending, consumer spending, and so on. In the US, I think 70% of the economy is the consumer. I would think that in Canada, it would probably be very similar. Most things are similar in Canada and the United States. So if the economy is 70% reliant on the consumer, and you're taking that much money out of the consumer's spending abilities, that's going to have huge implications, negative implications on the economy. I think most people would agree with that statement.
So okay. So to keep that conversation going regarding 70% of the potential money coming into economy is based on the consumer, there's also, and this perhaps is a little bit of a divergence, but there's this conversation, and in fact, Tiff Macklem more or less came out and said it, that the hand is not talking to the fist here as well in Canada, which is that the Canadian government, or the federal government, is still putting money into the economy that perhaps we don't have, or that the economy shouldn't have put into the economy, and it's delaying the inevitable of the impact of these interest rates. Do you believe that, based on what you're understanding, that is the case? And in your mind, how does that impact both the interest rates and the consumer economy?
Well, it is unique that the Bank of Canada, Tiff Macklem, would be kind of saying stuff like that. They usually stay apart from politics and just make decisions. And I think his saying was that the Bank of Canada is rowing in a different direction than is the federal government, which means they're trying to slow down inflation by increasing rates. But if the government is increasing spending like they are, then that's inflationary in and of itself. So they're rowing in two different directions in the sense that the federal government, but I think it's also provincial governments. He wasn't just blaming the federal government, he was blaming governments, which would be provincial governments, obviously spending as well. So it's various governments that are spending. It's not just one government. So the result of all this spending is inflationary when he's trying to be deflationary with his interest rate increases. So I think that's what he was that's what he was saying. And I mean, listen, I don't think anyone can dispute that excessive government spending is inflationary. Now, if we do get into a deeper recession in 2024, the argument would be, okay, what can the government do? What can the government do to get us out of a recession if their spending is maxed out and they can't really spend anymore? The only bullets really in the gun to fight a recession would be the Bank of Canada rate, which is at 5%. And if that's the only thing they can do to kickstart the economy is to start chipping away at that 5% because they can't really increase spending, that's kind of the argument there. I mean, the United States is in the same boat. And what I always argue is, I mean, look at the US 10-year Treasury yield before you look at the 5-year Government of Canada bond yield, because that's the lead. That's the lead in terms of where we're going to go. And we saw it today. We saw the inflation number come out, yet the bond yields went down because the US 10-year Treasury yields came down. And the US right now is spending $1 trillion on their interest costs. I believe Canada's at about 50 billion or something like that a month. I'm not sure. I saw some graph, but the US is at $1 trillion just their interest cost on their debt. And I think we know it's at $34 trillion right now. So this is a problem. I mean, that kind of spending, that level of spending, because if we head into a recession with exorbitant spending, usually a government will pay down their debt when times are good, then they'll increase their spending to get us out of times that are bad. And what's happening right now is it seems like the government spending is so high, you would think that things are worse than we're led to believe because of all this government spending. And again, how are we going to get out of a recession? It's probably lowering rates. It's really the only way to do it if you think about it.
Yeah. There's a lot to be said about. There's so much to digest in everything you said there, Bruno. Thank you as always for breaking that down and explaining that in a clear manner. I think, out of all of that, we always try to come back to earth and say, okay, well, based on everything that you just said right there, what is the number one thing that affects me as a consumer and or a homeowner and or a real estate investor, and how does that impact my livelihood is typically where things go. Because obviously for most people, it's interesting to know about why is the government doing this, but it usually comes back to earth and they say, okay, now what does this mean for me? What does this mean for me if I'm a homeowner? What does this mean for someone who wants to buy a home? So let's move into this next conversation, Bruno. And I'm make you put predictions out there, but I'd love to ask for you to give me, based on the information that you've been gathering over the course of the last year with all of these changes, and with the most recent news and information regarding what you just spoke about, plus inflation as of the time of this recording staying relatively flat. What are your, proposed suggestions that we are likely to see on the real estate side of things, value-wise, going into 2024? If you had to kind of, and again, I'm not asking you for definitive answers, but best guesses maybe.
So what I think, again, I'm a data guy, so I look at the data. And it's interestingly enough, I did a presentation this morning, and part of the presentation was looking at the CREA stats, the Canadian Real Estate Association, their stats and their data and what they say the average home is worth across Canada. Of course, Canada, it's different in Vancouver than it is in Saskatchewan and so on, and maybe even Toronto being a little bit closer to Vancouver given the values. But when I looked at the overall Canadian average stats, and I can send you this after we're done the recording so you can see the graph, you can clearly see that when rates go up, values go down. And we know that because the peak real estate market would have been February 2022, when the average home in Canada was, I think, like 800 and something thousand. It was very high. And I think we all agree that that's probably too high. But as rates started going up, we saw an immediate drop in the average prices. And we can see that when rates started dropping in the spring of 2023, remember we were down below 5%, we got into like 4.64%, fixed rates, we saw values actually started to inch upwards. And then rates went up and values started to come back down a little bit. I can show you what I'm talking about. It's better to show in a graph. But as rates come down, property values go up. And that's kind of what I see since February 2022, when the rates started going up very quickly, values started coming down very quickly. And in 2024, if we agree with the Fed, that's calling for, I think, 3/4 rates to come down. We agree with some of the economists, they're calling for 2% rate reduction. I did send out a report that shows when rates come down, what rates were in January, the year rates started coming down, to what they were in December. And I think I had 4 times when rates were coming down in 2021, 2020, then the Great Recession, the financial crisis, the pandemic. I think I even went back to the 90s. And each and every time they come down quite a bit. The average, I think, was 2.5%. The pandemic, it came down, I think, 1.5%, because the Bank of Canada was 1.75. They couldn't come down further. But in other cases, they've come down quite a bit. So if rates do come down, and some of these economists are correct in saying 1 or 2%, based on the data I see, real estate values will respond by going up. And, we know there's a supply issue. We hear about it all the time. You saw the housing starts. The housing starts were very low. We're not keeping up with immigration. Immigration is some 500,000 a year. We need to build more homes. And if we don't, those values are just going to continue to go up and up and up. And I'm an immigrant, and I came here when I was 2. My father and my mom came from Eastern Europe. They settled in Windsor, Ontario. The first thing my dad wanted to do was buy a car. The second thing he wanted to do was buy a house. And I think that goes without saying, is if you're an immigrant to Canada, I think you want to buy a house. I think most people want to buy a house. I don't think they want to rent. And that's just my personal opinion. They want to buy, they want to own, because you can't own a house in Czechoslovakia back in the day. If you're my father, it was very difficult to own a property. But coming to Canada and having that opportunity to buy a car, have your own car, wow, that was great. And then you buy your own property. Oh my God, you're a king, right? That's fantastic. You feel so good. And if people want to buy homes, if immigrants want to buy homes, Canadians want to buy homes, we have a 65% home ownership rate right now. It's far lower for younger people, but that's a stats from 2021. And a lot of those people that own homes, we know, are immigrants, and they want to buy a house for their family. So, and I don't like,
Yeah,
do they want, and what do they want to buy? Do they want to buy a detached? Do they want to buy a townhouse, a semi? How many really want to buy a condo? I think those detached homes, townhomes, semis are going to become very valuable as the supply demand continues to be a big issue. And we know
so that leads me to the next question I'd have on that, Bruno, is, obviously what your approach, or I should say your understanding of the data, is probably not, I'm not going to argue against it at all. But for so many, they're suggesting, again, there's conflicting information, because you also have to look at this and say, who's the source and who's providing the feedback and based on what information. But there are some that are out there suggesting that housing affordability is quite simply, it's too unaffordable. People can't either purchase or qualify. And for that reason alone, there is a proposal that we may see houses either flatline in value or not rebound like you would assume with rates going down they might. I agree with you, and I get your point in regards to population and so growth and so forth. But I guess I'll ask you the question: do you believe that housing affordability is too out of whack for Canadians right now, and that it's not sustainable to continue growing at this rate? Do you think that we are in line for what some propose as a correction, or do you believe that where we are right now, we've already seen this correction with the higher rates?
During my presentation this morning that I referenced, it's Kitchener-Waterloo. Kitchener-Waterloo is a good market. I looked at then versus now. And what I do is I look at when the market was booming. And the market was booming in February, March of 2022. That's when, you recall, we had multiple offers, 30, 40 offers. People were going in firm. There was no condition on financing. It was crazy. Like, every broker was saying, oh my God, like the market was such a seller's market when rates were very low. They were ultra low. But the 5-year rate at that time was 3.19. And what I did is I took the value of the house in March of 2022, and I can send you this as well, and I compared it to what the average price is in Kitchener now relative to an interest rate of 5.09, call it, on a high ratio first-time home buyer. Not only was the down payment 20,000 less, the mortgage insurance was like 7,000 less, your actual monthly payment was less. So when the market was booming in 2022, it was less affordable to buy a house than it is today in Kitchener, based on the average home price and where interest rates are today. So it's more affordable today. And I did the presentation in front of a bunch of realtors, and I showed it to them, and a lot of them were taking their cameras out. They were taking pictures. I said, listen, I'll share this presentation, as I will with you, and you can see, just based on the data, not only is it more affordable on a monthly payment basis, you need less down payment, mortgage insurance is less, and your balance at maturity is obviously going to be less because your mortgage is less. And if your house goes up in value because interest rates come down, then you're creating even more net worth for yourself and more wealth for yourself. So I got the data in Kitchener-Waterloo, and I could probably do the same data in different markets and show you that it's actually more affordable to buy a house today based on what I'm talking about than it was in 2022. And we know a lot of people are making more money than they were in 2022. 2 years have gone by, they're making more money. So not only has their income gone up, mortgage payment is less based on a higher interest rate, but a much lower mortgage amount. So I can share with you that data. Every market's different. I'm talking about the Kitchener-Waterloo market. It's where I did my presentation. You can substitute values from 2022 with the 3.19 interest rate that was available. Everyone says, wow, 3.19, what a great interest rate. Yeah, that's what you had in 2022, but you had it on a much higher mortgage amount because that same property was worth so much more. Your down payment was $20,000 more. Everything else was more expensive. So overall, I would argue, based on those stats, which I don't think anyone can debate. I mean, they're factual. The stats are coming from the real estate board. It's your average real estate prices. There's your high ratio 5-year fixed rate. There's your payment based on values that are the average value these days. And you're making more money 2 years later.
It's a good reminder for those out there listening to, before you make a quick decision, to look at the data, and another reminder to look at things through a different lens. Real estate is often considered a very emotional decision, and we know why. Like you just mentioned, obviously your dad moved from a foreign country to Canada, and one of his first things that he wanted to do was to own a home. And I can imagine that his feelings around owning real estate or owning a home were probably over time, he probably had an emotional connection to owning his home. Am I fair to suggest that?
I did too. I think we all remember our
Yep.
first house. I bought my first house in Kitchener, and I moved from Toronto. I lived in an apartment. I got to buy a little semi. My son was like several months old. I had a backyard across the street from a park. And I don't remember what interest rate I had. Who cares? All I remember is I could afford it. It was a house. I owned it. It felt good. So yes, for sure, my dad had a great feeling. I think we all do when we buy our first home. And we live in it. And, again, I don't, based on, and I got to kind of make myself clear here, that home I sold 3 or 4 years later, I didn't make a lot of money on it, but it didn't matter. I mean, it's your home. So if you're buying a home to live in it, I think that's important. Do you really care if it goes up in value, stays the same? I mean, if rates come down, the value goes up. That's great, but I still got to live in the house. And 3 years later, rates might go back up again, and then my value goes up and down and all around. But it's an owner-occupied home. Now, of course, for those on the line that are investors, they might be looking at, okay, does this make sense? If rates come down, how much do values typically go up? And you can look at historical data. You can look at where rates were and where your average home prices were, and do they go up or down as rates go up and down? The data I have is just the last couple of years, so I'm not going way back. I'm using 2022 when rates skyrocketed and values plummeted, and then I'm looking at the spring market of 2023 when rates started coming down a little bit and values started inching up. And then when rates went back up, values came back down. So you can see it in the data that, you know what, if rates come down, there'll be a lot of people coming off the sidelines, I think. I think people are waiting for rates to come down. But as they wait for rates to come down, the risk they have is that property values will start to go up and they'll be just kind of running after it. Where, if you're buying a house to live in it, just look at that emotional connection to owning a house. And especially if it's your first time home, obviously contact your mortgage professional and talk to them, and they can let you know what the cost is, because it's not cheap to rent. I mean, if you're going to go rent, my son was just born, right? We were in a 1-bedroom apartment. I mean, were we going to continue living in a 1-bedroom apartment? It was it would have been very tight. So if we had to move, we're no longer under rent control. So first thing I want to do was buy, right? I looked at Maple, Ontario. I looked at Kitchener, and I settled into Kitchener.
Yeah, that's really interesting and good feedback. I mean, I think that's one of the things that I try to remind those people that are overthinking it too much, the overly analytical types, is well, if you are analytical, in fact, read the data that you just shared with us. So this is what people need to know and people need to hear. But if that's not who you are, and you are someone who's more connected to the outcome, well, the positive side, as you just mentioned, is you have a home, you have a place to live, you have a place to call your own. And generally speaking, it's going to pay off in the long run, as we've seen happen time and time again. It's really interesting to me. I mean, posting more and more content on YouTube these days, I'm finding that there's a lot of people out there who are I don't even know what you call it. They're cheering on the potential crash, who are very who call me the FOMO guy of real estate. I tell people FOMO, and actually it's the exact opposite. I don't tell people like don't go buy real estate because it's going to help me. I just say go buy real estate because I think it's a great financial decision for most people, assuming they prepared themselves and they have the ability to do so. And one point that I wanted to get into, Bruno, is something that we didn't talk about before, so I didn't prep you for this, but this is something that I've heard the commentary around this, but it's not something that new, and I've been seeing this for the better part of the last couple years now. But obviously, the last year, it just seems like it's continuing to push that way. Now, we know that in Canada, there are a lot of corporations starting to do what we've seen in the US. So we've seen these large corporations come in and start to buy single family homes, hold on to them, and they're very well funded, and they seem to be making their way through different neighborhoods and cities and communities. It seems like they're starting at lower cost price points, but I know they're going to start to work their way up into higher priced assets. That we're seeing this all across the United States, where it's essentially squeezing out the lower to middle class income earner, because it's providing less supply, and there's not really a real there doesn't seem to be a real way that the government is saying, hey, let's create more single family home supply. It's typically condos. My point is that I feel like the quote unquote middle class Canadian of the past 40, 50 years up until the last 3 or 4 or 5, it seems to me that real estate is going to continue to become more challenging and harder to get a hold of. And you're really going to have to make it a real focus, as opposed to almost accidentally falling into homes. I guess that was not really a question, but just what are your general thoughts on that, as far as both the corporations impacting supply and the middle class homeowner being able to realize those dreams?
I think a few things. First comment would be on values plummeting, a real estate crash, if you will. And you mentioned that some people are cheering this on. I'd have to remind everybody, like, I've been in this business since 1990, and in 1990, there was a real estate crash. Values plummeted in 1990. And the reason values plummeted was because there was an oversupply. So we had an oversupply. It's your basic economic supply and demand equation. We had too much supply, prices plummeted, and that caused the real estate crash. And then a lot of trust companies back then, for those that are on the line that remember, a lot of them got bought by banks or went out of business. Central Guarantee Trust and Royal Trust and all these other trust companies ran into difficulties back then. So the issue was, in 1990, too much supply. I would argue that's not a problem. And what you just mentioned makes it even less of a problem. If we have too much demand and too little supply, and the demand is being stoked by corporations that want to buy homes, that's going to even further drive the price points up. I think you would agree, because now we have more demand. Now we have corporate demand buying these residential homes on top of immigration, existing, everyone else that wants to buy a house, people graduating university, starting families. I mean, we have your regular, you know, folks that want to buy a house when they start a family and so on. We have immigrants that want to buy a house. Now we have these corporations, which I have heard about, that want to buy a house. And I first heard about them in 2022. Can you imagine if they went out and bought $1 billion of properties and properties went down 25%? I mean, they would have lost $250 million. So, I mean, right now, I can only look at what we have right now. And I look at the markets, and the Vancouver market. I was just looking at the Toronto market. We have a lot of listings. Right now, it is a buyer's market, in my opinion. In many markets, it's a buyer's market. It might be a seller's market in Manitoba, Saskatchewan, Alberta, but it's pretty much a buyer's market here in Ontario in many markets, because we have a lot of supply and not that many people looking to buy, because a lot of people are sitting on the sidelines because they think rates are going to come down. But I would argue that, you know what, if you want to buy a house and you can afford it, the monthly payment is good, why not get into the market right now if rates come down and these values go up? And if we agree that there's going to be all these people buying homes and so on, I mean, corporations included. I personally am not a big fan of corporations buying homes and so on. I mean, I always look at homes as, for the most part, people buy homes just like I did for your family. Maybe some smaller investors might buy a rental property and so on. Anything that really drives up, like, I guess what I'm trying to say is anything that drives the price of homes up in Kitchener that doesn't relate to the economic factors of Kitchener. So the economic factors would be immigration coming and settling in Kitchener, families looking to buy homes, builders building homes. Now I have this corporation that doesn't have any ties to Kitchener influencing the values of the properties outside of the economics of the community, right? Because you always want your teachers, your firefighters, your people that are going to work every day to be able to buy a house in the communities that they live in. And if you get these outside influences driving those prices outside of affordability because they're corporations and they have all kinds of money, I mean, personally, I disagree. I don't like it, and I don't like the implications that it would have. Now, having said that, if they are renting these places out, they're not just sitting on vacant properties. That's another problem. Like, if they are buying the homes to rent them, and people are able to go in there and rent and have a place to live, that's a different story than buying up properties and just leaving them vacant just for the investment purpose of them. So, it's of course, I mean, you always want a free market, but when it comes to homes, you also want a market that's conducive of the people that live within the community and work and go to school and so on.
There's a lot to unpack there, as usual, Bruno. Thank you for that. And I really appreciate your opinion on the matter. I guess to kind of circle back, and I didn't pick it up there. I mean, just to give me almost a direct in your mind, would you suggest that the future of real estate will or is likely to become more unattainable for the average income Canadian family, therefore providing more of a reason for them to get in sooner than later?
Like I indicated earlier, it's more affordable to buy a house today. The supply of homes in most, I speak on behalf of Kitchener-Waterloo, the GTA, Toronto. The supply of homes is there. The affordability is impacted by the government stress testing, right? So the government's saying that if your rate is 5%, we're going to add to make it more difficult for you to qualify. That also impacts affordability. It's a number that says, well, in 5 years, your rate's going to be 2% higher, but your income isn't going to change. Most people would think in 5 years, I'm going to make more money. And, even if my rate goes up, I'll find a way to afford it. But the stress test in and of itself is adding 2% And if you think about it, it's adding 2% to a 5% mortgage. You're saying, okay, you're going to qualify at 7. So that makes home ownership less affordable. The positive to that is maybe, you know what, maybe it's better I don't buy a $900,000 home in Kitchener. Maybe, because of the stress test, maybe I'm forced into a $700,000 home. You know what? In retrospect, you might think that, okay, I mean, you were guided into the right direction. So there's always pros and cons. But when we look at the stress test in and of itself, that makes it more difficult to own a house. And then a lot of people that work in the communities that they live in, maybe they're single and they can't afford the house based on the stress test. And then they're forced into a rental apartment where the rental apartment does not stress test. They can charge whatever rent they can get for a new person to get in there. And then the person that is pushed out of home ownership of a condo, say, is now renting a condo, and the payment on the rent is higher than the payment would be if they owned. I mean, it could happen. I mean, and all they do basically, I would imagine, is they check your credit. They say, oh, okay, you're a nurse, you make whatever 100 grand a year, sure, I'll rent to you, you're a great tenant. But yet that person doesn't qualify to buy in the community they live in, and they're forced into rent. So there's, like I said, there's positives and negatives to everything. But the number one thing to affordability right now that I hear for mortgage brokers in the communities and everywhere that I talk to, it's not corporations buying homes. It's the stress test. The stress test is pushing a lot of people out of home ownership. That's our number one issue that I hear is self-inflicted.
Well, that's really interesting. So just on the backs of the OSFI saying that they're going to keep the stress test as is for the time being. So I can't imagine that's likely to change in the near future. So
and there's
really
positives to the stress test. There's financial responsibility, but there's always unintended consequences. And I think everyone would agree, if you're making 100 grand a year, you're living in a community, you should be able to purchase maybe a condo or something. But if you can't, because the stress test is pushing you out of the market, and you're forced into a rental apartment where you might be paying exorbitant monthly rents, because we know the inflation on monthly rents has been sky high, that's the unintended consequence. So I'm not entirely disagreeing with, I get the advantages of the stress test. I get the financial responsibility, making it risk adverse. It worked 5 years ago. We know 5 years ago, the 5-year rate was 3.5. And I don't know if we stress tested 5 years ago, but if you qualified at 5.5 and you got 3.5, and now you're up for renewal and your renewal comes in at 5%, well, you know what? There's the success of the stress test. So again, I just want to make it clear, there's always positives, but there's always those unintended consequences. And maybe that's something that maybe down the road they can look at for first-time home buyers only, maybe a 10-year mortgage, where you get a 10-year fixed rate mortgage and there's no stress test on your 10-year rate. Maybe that's something that we can consider down the road. It's 10 years, for goodness sakes. Do you really want to stress test someone who's going to be in a mortgage for 10 years and they get the same interest rate for 10 years? Maybe that's something. Maybe 5 years, okay, stress test. But what about a 10-year? Can we leave the interest rate for 10 years same? After 5 years, we know it's open on 3 months interest. So maybe that's an opportunity. So there's always things that maybe people can consider to help these people buy homes in the communities that they serve and live in.
I think what I'm hearing from you is that we just need to take a different approach, and not something that we typically see from governments. So we'll probably be waiting a long time. In the meantime, based on that presentation you had mentioned that you take, which I hope you send over my way, perhaps we'll insert it into the conversation here for the YouTube watchers and those watching on the YouTube, so they can see a little bit of that as well. We can dream, we can hope. You probably have a lot more influence as the vice president of sales for one of the top lenders in the country. But I'm gonna cap it on time here today, because this is so much information. And Bruno, they have to have you come back on. So if you'd be willing to do so, I'll be reaching out to you in 24 and having another conversation, because I know for a fact that there's a lot of people that are going to get a lot of great information out of this. So Bruno, thank you so much for taking the time to connect with me today. I'll put any of the comments or notes as far as how you'd like to be reached, or if you don't want to be reached, I'll put that in there as well. I really appreciate you.
Yeah. Reach your mortgage advisor, reach you. That's what I would
Awesome.
say. Reach you.
Cool. Thank you so much,
Okay.
Bruno. Appreciate
Thank
you
you.
very much.
That was an unreal episode of The Flow. I hope you enjoyed it as much as I did on my side right here. If you haven't already done so, make sure to check out all of the incredible resources that we have available. You can find us on Instagram at Flow Mortgage Co. You can find us on our website, getflowmortgage.ca. And of course, don't forget our free first-time homebuyer masterclass that's currently available on our website for anyone who listens to the episodes. And if you loved what you listened here today, the only thing that we ask for is to share this with someone else that you think this could help. And hey, maybe leave us a great review online.